Hello guys, welcome to RP Academy. So from today onwards we are going to start the Companies Act 2013. Also you know very well that I have already taught you the Companies Act in the last few sessions when you were having your 2025 exam cycle. So there are few changes that need to be made in your Hindi English lectures that I will be definitely making and providing you a separate lecture. And this particular lecture will be for English medium students who do not understand Hindi so well. Okay, so if you are having any kind of feedback, because this is going to be my first lecture in English for all of you, so if you are having any kind of doubt, if you are having any kind of feedback, you can just share it with me. Okay, so let's begin with our lecture. Also I here will be working on these lectures for you, so I genuinely need a support and motivation from your side. So whenever you are watching this lecture, make sure you are hyping these lectures, you are liking these lectures, and you can also spread the word. Okay, the bare minimum that you can do for us so that our reach is good. And of course when you are having a good reach, you feel like okay, people are liking the lectures. If there are certain number of views with a very good average view duration, I genuinely feel that okay, people are liking this particular series and I keep continuing teaching that. Okay, so that will be my motivation. So just do the bare minimum that you can do for me, and of course I am here for all your doubts, everything. So it will be just like a give and take relationship where you are studying from me. I will try my best to teach you in the best possible manner, and your duty is to support me. Okay, so let's begin with our lecture first. So we are going to start about the Companies Act 2. So before learning the act, we have to understand why companies even exist, right? So now let us take an example where we are supposing that there are three friends. Okay, let us consider there are three friends, Rahul, and what should be the name of other two people? We can just give them the names Priya and Aman. Now you know very well that we are having three friends, and they are starting a business. So each contributes, let's say 10 lakh rupees. So now the whole contribution by each of them will be 10 lakh, 10 lakh and 10 lakh, that is 30 lakh rupees. Fine. Now what will happen? See, now they will simply initially start that. Okay, after they will start a business. Fine. Now what will happen? Initially everything will be fine. After 2 years the business is suffering losses. Now they have some creditors who are demanding, let's say 1 crore rupees. Okay, the people who have provided loans or who have lent some amount to us. Now question is, who is going to pay? Rahul, Priya or Aman? So if it is a partnership, each partner is personally liable, meaning even Rahul's personal house can be sold, his car can be sold, his bank account can be attached. This scared entrepreneurs for centuries. So people were afraid that if they will start their business, there will be a lot of risk involved, right? So government said that if people are afraid to take risk, industries are never going to grow, right? Industries will never grow. So here we will say that okay, let's do one thing, let's start a new concept. And they invented the concept of one of the greatest legal creation, that is company. Now what is a company for you? Tell me, what is a company for you? See, you will understand that a company is simply an artificial legal person. An artificial legal person. Now you will say, ma'am, what do you mean by an artificial legal person? See, if something happens, like let us take an example. I was going through the road and someone had actually crashed my car, okay, with their car. Now what will happen? I am going to sue that person. Fine. If consider that someone feels that I have committed a crime, what they will do? They will sue me in the court, right? In the very similar way, for an artificial legal person, now because we were having three owners, let us say for a company we had three main shareholders and there were many other small shareholders. So whom are we going to sue? So here comes the concept of your company. For example, you would have heard that there are certain cases going against particular company. So we actually, what we do, we sue some people. Okay, we be sued, meaning we also get sued in the court. So here you will see that if you feel that fine, okay, I had purchased few things for consumption and let us say some chocolates, and the chocolates were of not the good quality, and now the person who has consumed those chocolates want to take a legal action. So against whom it is going to take the legal action? Against the owner of the company or against the company itself? Of course against the company. So here we say that we are suing the particular organization. Understood? So here you will see that the Company Act is saying that it is an artificial legal person incorporated under which act? Of course under the Companies Act 2013. Okay. Also they says or any other previous law, like we were having earlier Companies Act 1956. So it comes under the section 220, which also maybe like there were actually different sections in a particular act too. So under section 220 we have defined companies. So you will see here the short title for the act is Companies Act 2013, which is extending to the whole of India, meaning it is applicable to the whole of India. It became enforceable on dates notified by the central government in the official gazette. Now, which all companies are known as companies legally? See, companies incorporated under this act or previous laws: insurance, banking, electricity companies, except where inconsistent with their specific acts. If they are not here specific to the acts under which they are defined under a particular category, like electricity, right, or banking. For example, if you want to become a banking company, here you have to follow the Banking Regulation Act as well as the RBI Act, and under RBI Act they tell you which all the banks are your scheduled banks, which banks are your non-scheduled banks. So here you have to register yourself first of all as a banking company. After first of all you have taken, okay, I have legally registered or incorporated as a company. Now I have to also get a certification of registration where I will be defined as a banking company. Okay, now special act companies and other specified body corporates. Now what are the special act companies? Like LIC Act, like SBI Act. So these companies are formed under the statutory laws. These are also known as statutory companies, right, or other specified body corporates. Now imagine you are creating a gaming character. The character has its own name, it has its own weapons, it earns coins, also loses money. Now even though it is not a real human, you will see here that it has a few distinctive characteristics, like it has its own name, its own assets, right? So here similarly let's talk about Tata Motors. So that's not a human, right? But I can simply say that Tata Motor owns some factories. Can I say that? Definitely I can say that yes, Tata Motors is owning some factories. Can I also say that it owns some land, it owns patents, it can borrow money from the banks or other particular debt instruments can be issued by the same, it can hire employees, it can pay taxes, it can sue people, or even it can get sued or be sued, right? So here how it is happening? Because the law is giving it a separate identity. Which law? The Companies Act. So here you are going to study about the key definitions. So first of all, Companies Act, as I told you, defines a company under the section 220. Okay, the clause is 20, the section is 2. Here it says that a company incorporated under this act or under any previous company law. Now we have few different kinds of company. For example, one person company. Now what do you mean by a one person company? Tell me, for you, what do you mean by a one person company? See, this was a very revolutionary idea. So earlier, if you want to have a company, there must be at least two, that is minimum 2 people must be there. The minimum 2 people were the requirement. Now government said, now if a single entrepreneur wants company benefits, then so one person company was introduced. Understood? For example, you would have seen so many YouTubers are there these days, a chartered accountant, a software developer. So they can start their own firms. For example, XYZ OPC Private Limited. So XYZ one person company Private Limited. So here you do not need a partner. So what is the benefit of the same? See here, when we are actually defining the company, we actually get the concept of limited liability that I am going to talk about to. Okay, first of all, you just understand that in OPC we have limited liability. Okay, what is limited liability? I will be just teaching you after completing this particular slide. Now, you will see that there are separate legal entities that these companies have, and also it will have a professional image, and here you can see there is an easier succession possible. Okay, so a company which has only one person as a member, the member must be a natural person, the individuals like you and me. Okay, and an Indian citizen. Now, body corporate under section 211. So what is a body corporate? See, students confuse this with the company. Remember, every company is a body corporate, but every body corporate is not necessarily a company under the Companies Act. What did I say? I said that every company is a body corporate, but every body corporate is not a company. Okay, can I make this kind of a Venn diagram, right? So here we have to understand that it includes companies incorporated not just in India but outside India, while it excludes corporations, sole cooperative societies, and specifically notified bodies. For an example, now you know about Google LLC, that is registered in USA, fine. It is not incorporated under the Companies Act, but still it is a body corporate. Understood? So body corporate is just like a universal term. It is a very big family under which company is only one member of that family. So if I give you an example of a real corporate, just imagine there is Alphabet, right? So Alphabet has Google, Google has YouTube, YouTube has Android, and Android has Waymo. So there are few companies, some may be just body corporate in different jurisdictions. So this umbrella concept is here a broader one. Okay, so if you are giving an interview, right, so let us consider that let us suppose that you have reached the PFRDA or SEBI interview, and the interviewer asks that can a company own another company? So you must know that yes, Companies Act specifically recognize holding companies, subsidiary companies, and associate companies, and their distinction immediately signals the deeper understanding. Okay, so a company incorporated outside India, it excludes corporations, sole cooperative societies, and specifically notified bodies, as I told you. Now, we have different kinds of companies. First of all, let's talk about private company versus public company. So what is a private company for you and what is a public company for you? Tell me. Okay guys, we will be studying this particular slide later because I told you that I will be talking about limited liability first. So let's talk about few things related to your Companies Act, then we will move forward. Okay, so here we are actually using the accounting principles. Who have completed my accounting classes, they must be knowing about it, but still we will talk about few things. So here there is a concept in accounts that talks about business entity concept. It says that a company is different from its owner. Company is different from its owner. RPA is different. RPA is a company. Okay, and I myself, whatever my name is, okay, so that name is a different person. Okay, now we say that the company is different from its borrower. How? Let us say that I own 100% of ABC Private Limited or RPA Private Limited. Though RPA is not a private company, also RPA does. I do not own 100% of RPA, but let us just say that. Okay, so legally I am not equal to here the RPA. Okay, so why I am saying this? Because we have, let us say that whatever I own, okay, I own ABC Private Limited or I own RPA company, but I am not equal to the RPA company, because if let us say that the company RPA has, let us consider 50 lakh rupees of bank balance, which it doesn't have as of now. Okay, now while saying this, that okay, RPA might have 50 lakh rupees in its bank balance, can I withdraw the same? I, the owner of this particular company? No, because it is company's money, not the shareholders' money. So this single concept is responsible for modern capitalism as well. So in the business entity concept, we say that company is different from its owner. So whatever, let us say that company was actually in huge debt, and the company was in huge debt in such a way that now company has already liquidated its asset, meaning it has already sold all the properties, all the lands, all the assets that it had, but it was not able to repay the amount to the creditors. Now in that scenario, if you are a company, can the owner of the company be pressurized to sell his or her assets? No. Here the company is different. Company is different from the owner. Okay. So owner has just invested a particular amount as in the form of owner's capital, and even you would have heard in the balance sheet equation that assets are equal to your what? Liabilities plus owner's equity. So here in the balance sheet, we keep the owner's equity as the liability for the company. Okay, understood? So suppose I have invested 5 lakh rupees and company had borrowed 5 crore rupees. So if the business fails and the company is unable to pay the amount, my personal home is not going to be sold. Okay, because company and its shareholders are different legal persons, and this is known as your limited liability. So if there was limited liability, for example, you see we talk about sole proprietorship. Okay, where the owner has 100% liability or unlimited liability. So here if consider that if there was no limited liability, then nobody would have created Amazon, Infosys, Reliance, Tesla, Google. Why? Because you understand that these companies need huge funds and nobody is going to take those funds in their own names. Okay, there is definitely a risk involved. Understood? Now you have understood that why are companies important, because these are separate legal entity. They have limited liability. Also you will see that they have perpetual succession. What do they have? Perpetual succession. What do I mean by perpetual succession? I mean infinite ownership. Okay, infinite life. Meaning, see, you would have seen Reliance. Okay, so Reliance was a company started by Dhirubhai Ambani ji. Now it was succeeded by his two sons, Anil Ambani and also Mukesh Ambani. Now their children are also becoming the directors of the company. So already we have seen that, or you talk about the Tata group, right? So there was Jamshedji Tata, and after them so many people came, and after that we had seen the biggest legendary in our own era, that is who? Our Ratan Tata ji. When he died, did the Tata group also die? No, because the perpetual succession is the concept here, that the owners will come and go but the company will remain. Okay, then there is an easy transfer of ownership, large capital can be mobilized, and there is a proper professional management that is being provided to these companies. Understood? Now let's move towards what is a public and what is a private company. So here you will see that a public or a private company depends upon the shareholding part. Okay, so let us consider that there is a ABC Limited company. Now ABC Limited company has listed few shares of itself on the National Stock Exchange. Now these shares can be easily bought and sold by you and me as an individual, right? So here comes the concept of public company, where the right to transfer shares is freely transferable. And talking about the number of members in a public company, you know very well, if the company has listed 10% of its shareholding, those 10% shares will be held by lakhs of people or thousands of people. So here there is no maximum limit based on the members of that particular company. Okay, but of course there is a minimum limit, that is 7 members. Public invitation. So they actually, when they bring the IPO, what is IPO? Initial public offering. They actually invite public to subscribe for their shares and securities. And the deemed status, it is a subsidiary of a company. Public company is deemed a public company, meaning if there is an ABC Limited okay, and that's a public limited company. So here you will see that its subsidiaries A, B and C will also be a public company. While for a private company, the shares are restricted by its articles. So who have restricted the shares? Company's article of association. See, in a private company, shares cannot be freely sold. How? See, consider you own shares in ABC Private Limited. Now, the company or its article of association may require approval or give existing shareholders the first right to buy. Suppose there are 4 shareholders, Rahul, Priya, Aman, and now we have another shareholder, Neha. Okay, now Rahul wants to sell his shares. Can he directly sell them to, let us consider that, Elon Musk or Mukesh Ambani? No. The company can restrict such transfers. So company keep the ownership within the chosen group. Okay. So here you will see that it is restricted by the articles. Now talking about number of members. So here you can have only 200 members. Okay. Maximum numbers in the private company can only be 200. And what are the number for your minimum members? That should be 2. So you can have 2 to 200 members in a particular private company. Understood? So that's clear to you. So here you will see that they say that it is limited to 200 excluding current former employee members. Now public invitation, you cannot okay, invite public to subscribe for such securities, and its deemed status, it is not applicable. Understood? Clear now? Why you cannot invite public here? See, because you cannot simply here go with a lot of people. It is meant for closely held businesses only. For example, a family business where you are having 50 shareholders, and that will be known as your private company. Okay, but if there are 500 shareholders, so it cannot remain a private company under this limit. That's why we have this 200 members limit as well. For public company, as we had already discussed this, there must be no maximum limit. So suppose a Reliance Industry has 50 lakh shareholders, that is allowed. Suppose TCS has 40 lakh shareholders, that is also allowed, because public companies raise capital from the public. Okay, and talking about the public invitation, you know very well that in a private company you cannot do the same. So it cannot invite the general public to subscribe for securities. Do you know that if there is any company that is bringing its IPO, first of all it has to change its name. So consider that it is ABC Private Limited company. So now it has to change its name from ABC Private Limited to ABC Limited. Understood? So it cannot invite the general public to subscribe for securities. Okay, that will be illegal. Understood? Now let's move to the next part. A small company under section 2 clause 85 of the Companies Act. See, the concept of small company came from this particular government's policy of promoting ease of doing business. So you have understood that, okay, what is a private company? Now, small company is a category of private company that enjoys reduced compliance requirements. Now you do not need to follow a lot of laws and legal things. Okay, now you have a reduced compliance requirement. So you have to understand that, consider there are two companies. Company A that has, let us consider company AB, just like an Apple. Okay, Apple company. So let us say that it has an annual revenue of 4 lakh crore rupees. Also, if talking about the number of employees, it can be 1.5 lakh. Fine. Now, take a small company, company B, that is a startup in, let us consider in India's any city, let us say Jaipur. Now, its revenue is just 80 lakh rupees. Okay. And talking about the number of employees, it has 5 employees where there is 1 founder and 4 engineers. Fine. Now what will happen? You will see that if both companies will follow exactly the same compliance requirement, what will happen? There will be a lot of burden on the small company. So they say that small businesses would spend more time on paperwork than on business, and many entrepreneurs will simply avoid incorporating their businesses as the companies. So the government created a special category known as small company and provided some special treatment to it. Okay, so it applies to private companies offering significantly reduced compliance burdens following the latest statutory updates. Now, what are the current limits? Understand that. See, a small company is not a new type of a company, rather it is just a classification under a private company where we say that okay, as per this particular condition, if the paid up capital must be up to 10 crore rupees and turnover should be up to 100 crore rupees. Okay, so here these are few limits. So private companies generally have fewer shareholders, less public money and lower systemic risk. Therefore, eligible private companies are receiving the compliance relaxations where we are talking about their paid up capital and their turnover. Now you will see here what is a paid up capital. I will just teach you somewhat things. Okay, you know about IPO. So what happens if IPO comes, or if you are having some kind of shares? Okay, article of association tells that how much capital we do we need. Now out of the here, better say allowed capital, okay, you will issue some shares. Now shareholders will subscribe to those shares and will provide some amount as of now and few amount later on. So here you will see that there is an authorized capital, there is issued capital, there is subscribed capital and paid up capital, also called up capital. So basically consider that article of association, and here the permission was given by, let us say, SEBI. They said that okay, you can subscribe share, it's authorized 1000 crore capital, meaning you can take 1000 crores from your shareholders, while the company as of now decided to just issue the shares for 500 crore rupees. Now let us consider that only 400 crore worth of shares were subscribed. It can be 500 also. Okay, now here the shareholders have paid 50% amount as of now and remaining 50% will be paid later on. So what will happen? You will see that the paid up capital for this particular company will be 200 CR, that is 50% of 400 crore. Understood? So here we have also a pending 2026 bill which proposes to double the statutory maximum cap to 20 crore rupees for capital for a paid small company and 200 crore rupees to enable future relaxation. Exclusive, it cannot be a holding or subsidiary company under section 8 non-profit or special act company. So they say that okay, you understood the concept of paid up capital, I am supposing that. Now talking about the turnover part, turnover simply means the value of goods or services sold during a financial year. So if you own a bakery and the total sale is for 70 crore rupees, so your turnover will be 70 crore rupees and that is not your profit. Now what is the profit? Of course, for 100 crore rupees sale you have 90 crore rupees of expenses, so 10 crore rupees will be your profit. Okay, so turnover can be 100 crore and profit can be just 10 crore rupees. Understood? Now as I told you that there are few important rules. First of all, we talked about your conditions, right? Turnover and paid up. Now you have to understand that Corporate Laws Amendment Bill 2026 proposes that we should increase the paid up capital to 20 crore rupees and turnover to 200 crore rupees. Why we are increasing the limit? So that government wants the businesses to continue growing without suddenly facing a much heavier compliance burden. Actually the government schemes also, they are providing relief there as well. Okay, now companies that cannot be small companies are your holding company, subsidiary company, section 8 non-profit company and special act company. Okay, so what are holding companies? Do you know what are holding companies? Do you know about Reliance Industries? I am supposing that you know about the Reliance Industries or Tata Group, right? Now you know there is a Tata Trust. Tata Trust hold, let us consider that to suppose, okay, 70% of Tata Motors. So Tata Trust is a holding company and Tata Motors is a subsidiary company. Similarly, for Reliance Industries, Reliance Retail is a subsidiary, okay, of Reliance Group. So even if the subsidiary itself is a small company, let us say that Reliance Retail is a small company, then also you cannot take the benefits of a small company because it belongs to a large corporate group. Therefore, the law does not grant a small company status. Okay, understood? Section 8 companies, you know, non-profit companies, so they have a very different legal framework. That's why they have been excluded. Fine, understood? Now, corporate relationships. So holding or subsidiary, you know, a holding company controls the board composition or exercises more than 50% of the total power, voting power of the subsidiary. So I gave you an example for what? I gave you the example for Tata Trust, where it was holding 70% of shares in whom? Tata Motors. Now, can I simply say that here, while we are having such kind of companies where, let us say, Google had created YouTube, then Android, then Waymo, DeepMind, so who is controlling everyone? Of course, Google is controlling, or better say Alphabet is controlling these companies. So it is a corporate group. Now suppose here Reliance has oil business, telecom business, retail business, renewable energy, financial services. Now, if everything is operated under one company, then what will happen? Here the risk will be confused, right? There are different investors for different companies, there are different kind of risk, different regulation, different management. So companies will create a separate company. So here they are creating subsidiaries. Fine. So a holding company is defined as the company that controls the composition of board meaning board of directors, right? Or it exercises more than 50% of the total voting power of another company. So there are two ways to become a holding company. First of all, you can either take the control through voting power. Let us say that I own a company ABC Limited that has 80% shares in XYZ Limited company. So ABC Limited will be a holding company and XYZ Limited will be a subsidiary company. Fine. And if let's talk about your next type, that is board of directors composition. So how it is being controlled? Can someone tell me? Suppose ABC owns only 35% shares, but normally 35% shares cannot be providing you the controlling shares, right? So here you will see that ABC has the right to appoint, let us say, 6 out of 9 directors in the board. Okay, so here who is going to control the company directly or indirectly? ABC, even though shareholding is only 35%. Okay, so what is happening here? Board of directors is controlling the management part as well. Understood? So here you will see that just like our cabinet ministers are there. So let us say that cabinet ministers are shareholders. So they elect a board and board appoints CEO. So who is running the company? CEO is running the company. So and who is controlling the board? Of course, the board is controlled by the shareholders, right? Understood? So that's how it works. So clear hai? And talking about a subsidiary company, a company that is being controlled. Fine. Now let's move towards associate companies. Let's move towards associate companies. These are defined under which section? Section 26. So here suppose ABC owns just 25% shares in which company? XYZ Limited. Who is owning these shares? ABC Limited, right? Now, can ABC control XYZ? No. But can ABC influence XYZ? Yes. Therefore, law created associate companies. So here associate companies are the one in which another company has significant influence, 20% or more voting power, but it is not a subsidiary. And they also here have some kind of joint ventures. They also include joint ventures. Okay, so a company in which the significant influence is there, that is more than or equal to 20% of voting power or control. Clear? Now, financial year and key managerial personnel. So do you know what is the financial year and who is the key managerial personnel? See, first of all, let's talk about financial year. Okay, so it is defined under section 241 of the Companies Act. Now they say that okay, all the companies need a financial year. So we will be starting the financial year as per Indian laws from 1st of April, okay, to 31st March. Now you will say how? See, talking about the current financial year, 1st April 2026 to 31st March 2027 will be your what? it will be your financial year. Okay, it is different from the calendar year. How it is different from the calendar year? So the calendar year starts from 1st of January, right, and it ends on 31st of December, and it is used for your normal dates and you in the daily life. But for a financial year, these are used for your accounting and are used by the companies. So can someone tell me that why are we using these financial years? What is the need? Suppose there is a company, okay, and it starts businesses on, let us say, 1st of April 2026. So the financial year for that particular company will be ending on 31st of March 2027, right? So at the end of this period, the company has to prepare its balance sheet, profit and loss account, other financial statements, and that's why it is very important for us to here have such kind of financial year, so that government has a particular information that how much tax it needs to collect, and also it can compare the companies based on their financial statements. It can calculate the GDP, also prepare the union budget. Otherwise it would have become very difficult. So for uniformity and conformity, here compatibility, we are doing the same. Okay, so here you will see that period ending March 31st, exception for alignment with foreign holding or subsidiary, it requires tribunal approval. Meaning, see, what is tribunals? Do you know what are tribunals? So here these are the small courts type of thing, right, which are handling the special purposes. So now if every company keeps changing its financial year whenever it likes, so what will happen? That will be a very chaotic situation. So here we say that, okay, let's take approval from tribunal and ensure that change happens only for valid reasons such as alignment with the foreign corporate group. Now consider that there is an Indian company that is a subsidiary of an American company. Now American company will be preparing its accounts from which date? 1st of January till 31st of December, and its subsidiary in India will be making its account from 1st of April 2026 to what? 31st of March. So there will be utter confusion. That's why Indian subsidiary may seek alignment with the foreign holding or subsidiary company's financial year, but of course they need here tribunal approval. Understood? Clear now? Now you make sure that you understand that the large MNCs always prepare consolidated financial statements, meaning all the subsidiaries that they have should have different year. If they have different year ends, so then consolidation will become very complicated, as all the companies have to provide their financial statement, and then only we can confirm the consolidated financial statements. Right now, key managerial personnel. Do you know we have Tesla and we have Elon Musk, right? Now consider that Elon Musk leaves Tesla. So is it going to hurt Tesla shares? Definitely it is going to hurt Tesla shares. Okay, but consider that we had Bill Gates who had left to Microsoft, but did it hurt which company? Your Microsoft? No. So here, just like a cricket team, okay, every team has a captain, vice captain, coach, manager, physio. Now different people have different responsibilities. Similarly, a company also has people responsible for managing it. So the role of key managerial personnel is here very important. Now suppose a company is committing any kind of fraud, then who must be responsible? Who must be held accountable for that particular fraud? Here comes the role of your KMP. It is an basically the company itself cannot go to the jail because it is an artificial company, and the law identifies the people who actually manage the company. So these are known as your key managerial personnel. So it includes CEO, MD, manager, right? These are the captain of that company. So what they will be doing? They will be making the major business decision, lead the business management, implement the company's strategies, and also represent the company on a public platform, right? And who talking about the MD? What does the MD do? See, MD is a director entrusted with substantial powers of management. MD is here having a substantial power of management. So here you will see that it in companies the same person can be CEO and MD, but of course it is a very powerful position in an organization. Talking about company secretary, see, they are not only filing forms, so here they are actually working like companies compliance experts. So if there is a board meeting that is going to happen in upcoming days, so a notice will be sent, agenda will be prepared, minutes of the meeting will be recorded, legal procedures are followed here. So all these things are done by whom? company secretary. Understood? And talking about your whole-time directors, what do they do? See, a whole-time director is a director who works full-time for the company. Okay, so if let us consider, we have two directors. Director 1 who is visiting company once every 1 month. Okay, while director B works from 9 a.m. to 7 p.m. daily. So director B is the whole time director. Whole time meaning that he is working for his entire professional time with whom? He is working with the company for its entire professional time. Now, chief financial officer. So chief financial officer is just like working as the finance ministry of the company. Here it will manage the budgets, account, cash flow, investment, borrowing, financial planning for the company. Understood? So CEO is running the business and CFO is running the finances, making sure that there is a financial discipline in the organization. Also it works with the budgeting and reporting part, right? And any designated officer one level below directors. So here we have BOD, then we have managing director, we have senior executive, and then we have managers, right? So why does a KMP matter? Because if a company is committing any kind of fraud, accounting fraud, who will be questioned? Here the KMP will be questioned. Okay, also the business agenda, business profile, so these are too much based on these KMPs. That's why we usually have KMP insurance as well. Okay, now next part, legislative updates and relaxations. So we have few 2026 bills that we can study, as they might become act in a very sooner time. So we have to understand first. Okay, so now they say that okay, we have 2020 as the year as the foundation. So earlier what was happening, suppose a company forgets to file its one form, there is no fraud, no cheating, no investor loss, just a procedural mistake. So even if such technical defaults happen, they can attract criminal consequences. So should entrepreneur face such kind of criminal proceedings for every paperwork mistake? Of course not. So here we brought the 2020 reforms. In the 2020 Act, it decriminalized minor procedural and technical defaults. So it was shifted from a criminal liability to a administrative civil penalty mechanism. Now we have brought this corporate governance 2026 bill. Do you know what is decriminalization? Simply there will be no punishment, rather you just have to pay the penalties. Okay, so the nature of punishment is changing from criminal prosecution, court processes, serious legal consequences of sending someone to the jail, to just paying some kind of penalties. Okay, so they are generally not treated like a here criminal. Fine. Now what does the corporate governance 2026 bill says? See, here it says that we will be tightening the accountability for directors and KMPs. So fine, because here we have seen they have a continuous independence obligation. So what we are doing, we are here introducing continuous independence obligation. So what is corporate governance? See, you have invested 10 lakh rupees in a company, you became the shareholder, but who is protecting your money? So here the company itself cannot do the same, because company is a structure, right? It is a building. So here the law is creating rules. These rules are together known as your corporate governance, under which the rule book for running companies honestly, responsibly and transparently is provided. Now why we are tightening these accountabilities? Because we know that okay, there are chances that directors become careless, a KMP may misuse the company funds. So who is going to suffer? Of course the shareholders, employees, creditors, right? So here we say that okay fine, let's do one thing, let us bring this continuous independence obligation. So what does this idea mean conceptually? It just you have a referee in a cricket match, so at the beginning he is neutral, halfway through he becomes a friend of one team, right? So what will happen? Will he be considered as independent? Definitely no. So corporate governance increasingly expects independence to be maintained throughout the tenure of that person, not merely at the time of appointment. Okay, so we want some kind of regulatory oversight, and that needs to be stronger. So here we say that okay, let's have some specialized regulators. Okay, so we talk about here regulatory oversight as well, where we say that let's have some special regulators, and we bring the regulatory oversight bill as well to expand the mandate and oversight powers of National Financial Reporting Authority, establish IBBI as the prime Valuation Authority, where we say that okay, see, we have to expand the mandate and oversight powers of our regulators. Fine. So we are talking about whom? We are talking about here the regulatory oversight. Now we also talk about NFRA. What is NFRA to you? It is National Financial Reporting Authority. So here you will see that if a company had inflated its profits, meaning it has shown that it has received huge profits in its account statement, so though it is not true, profit and loss account, right? So here it will say that okay, the fraud is discovered, investors are losing money and confidence in market is declining. So strong oversight improvement will improve the trust in financial reporting. And here we will talk about Insolvency and Bankruptcy Board of India as the prime valuation authority. So here we say that okay, suppose the company is merged, acquired, restructured. So how much is it worth? 500 crore, 5000 crore. So accurate valuation is critical here because it is going to affect the shareholders, creditors and investors. So earlier in 2020, we decided to reduce unnecessary criminal consequences for minor procedural default. Now we are saying that we have to increase the accountability where it really matters. So we have to strengthen the corporate governance, we have to strengthen the regulatory oversight and improve investors' confidence. Fine. Now ease of doing business and compliance. So what do we talk about in this ease of doing business? Tell me, do you have any idea what is ease of doing business? What do we want to do through ease of doing business? See, government simply wants that there are more and more companies that should start their business or they expand their businesses so that our GDP grow. So now what do? We actually reduce unnecessary regulatory burden while maintaining legal compliance and transparency. So here it does not mean that we are not going towards the no laws, no regulation. No, we are having laws, we are having regulations, but we are actually reducing the too much of compliance burden from our companies. So what did we say? First of all, we said that okay, let's bring some reforms under the DIN, that is Director Identification Number. So it is an Aadhaar number for a director, just like an Aadhaar number. It is just an analogy that I have told you. So every director has a unique identity. So now you know what is a know your customer, meaning we have to keep the director's personal details updated. For example, his mobile number, his email address, his residential address. So earlier there was a rigid annual submission requirement. Even if nothing changed, director had to submit this DIN KYC. Now we have replaced it. Okay, the annual filing has been replaced by whom? Triennial comprehensive update. Okay, so here we say that a fresh update is required only if you are changing your details like mobile number, email address or your any other personal details, residential address. Fine. So here what is happening? The new approach is reducing the repetitive compliance and ensuring that changes are reported promptly as well. Now we have section 184. Filing reliefs, where we talk about disclosure of interest that is mandated only upon an actual change. So here we say that okay, we earlier had MBP1 disclosure of interest, which is a form through which a director discloses his or her interest in other entities. I'm not talking about the principal interest wala interest, I'm talking about here the interest like I have in RPA some interest, right? So here we say that okay, consider there are two companies. Company A wants to award a large contract to company B. So why it is happening? Is there any conflict of interest? If yes, then what will happen? Why there is a conflict of interest? Let us consider that company A and company B both have same directors. Now company A director will try to provide all the large contracts or the small contracts also to the company B. So here the law requires disclosure. Earlier directors had to make annual filings when nothing had changed, but now we say that MBP1 is required only when there is an actual change in director's interest. Understood? So we have to reduce the unnecessary compliance burden but also preserve the transparency. Small company, now they say that eligible companies are going to benefit from the 50% lesser penalties, exemption from cash flow statements and excluded from mandatory auditor rotation requirement. Now we do not need to we should have file 3 balance sheet or annual financial statement. Let us say balance sheet, profit and loss account, and cash flow statement, right? Small companies do not need to file a cash flow statement. Provided this statement, also they are excluded from mandatory auditor rotation requirement. Also they are exempted 50%, they are actually charged 50% of the penalties. So basically minor defaults are going to attract very lower penalties than for larger companies. They are exempted from preparing a cash flow statement, and they are excluded from mandatory auditor rotation requirement. Fine. Understood? So government is not removing the accountability, rather the law has moved towards event based compliance instead of repetitive compliance. I hope now it is clear to you. So can I simply say that ease of doing business reforms are aiming towards reducing the unnecessary compliance. Also we have replaced the annual DI and KYC with a triennial update, and we have also talked about requiring MBP1 only when there is an actual change in director's interest, right? Now Restructuring 2026 bill. So what is this restructuring bill? Now do you know what is a restructuring bill or restructuring actually for the company? A company has taken a loan from some bank. Now it is not able to repay the amount to its creditors, okay? So what will happen? They will go towards IBPC code, or they might go towards SEBI code, right? So in SEBI code we talk about restructuring, where we say that okay, let us do one thing, let us not shut down the business, we will try to revive the business, but also change the board of directors or the management part. So here they say that okay, first of all, in restructuring what is happening, we are reorganizing the structure of a company to improve efficiency, growth, profitability or management. Now why do companies need restructure? Because if a company wants to reduce cost, increase profit, expand internationally, merge with another company, attract investors, separate its risky business, or also want to improve the efficiency, so they are not creating entirely new business, rather they are restructuring the existing one. So here you will see that we have brought Corporate Laws Amendment Bill 2026, where they say that we are providing major overhaul for corporate restructuring for frameworks. So first of all they talk about fast track mergers, where they say that okay, if first earlier what we were doing, a company A was merging with company B and becoming one company, and we called it as merger. So here mergers are actually reducing our operating costs. They are also eliminating the duplicate work and providing us better technology and a huge customer base. But earlier they had to take multiple approvals, extensive procedure was there, and we had to take a considerable time to complete the process. Now we talked about proposed fast track merger reforms, where they say that to make the mergers, eligible mergers, to be precise, faster, simpler, more efficient, we should go with this. Fine. So here we have talked about aligning with the standard tribunal sanctioned compromises. Okay, so here we are relaxing member and credit approval thresholds for which must apply with whom? Our tribunals. Now we also talk about AIF as LLPs under your which particular part? IFSC. Okay, IFSC, right? So here alternative investment funds, so just a professionally managed investment pool for startups, infrastructure, real estate, private equity, and LLP is limited liability partnership. So basically it is just a partnership style flexibility, but with limited liability, where the partners do not have to sell their properties if the company defaults, right? So in International Financial Service Center, all the AIFs can work as LLPs. Okay, so the bill is proposing to make it easier to establish AIF as LLPs, particularly under this particular framework. So more flexible legal structure will be there that will encourage investment and simplify the operation. Fine. Also here they are talking about merger schemes under which they talk about National Company Law Tribunal, which is a specialized tribunal that is dealing with important company law matters. So okay, so they say that now what we will be doing, we are providing NCLT jurisdiction over the transferee or resultant company. So if the companies are filing for mergers, then that will be streamlined through your NCLT. So there are two types of companies. Okay, one is transferor company, transferor company, and another one is transferee company. Now first of all, let's talk about transferor company. It is a company that is transferring its business or assets, and to whom it is transferring it? To the transferee, the one who is receiving the same. Okay, so ABC Limited merges into XYZ Limited, so ABCD Limited will transfer its business to XYZ Limited. So here what happens, sometimes companies reorganize to create an entirely new company. So the newly formed company is known as the resultant company. So we have said that, okay, now we will simplify the filing procedure by identifying the relevant NCLT based on the transferee or the resultant company, that is the final company. Okay, so every proposal now will have one objective, making restructuring easier without compromising legal oversight. Okay, understood? So that's it for the day. I hope you like the lecture. If you like the lecture, you can just tell me that how was the lecture. Do you want the similar kind of lectures, or you want me to improve somewhat? So you can also share your feedback through comments. So make sure you comment, and also make sure that you hype the lecture. Okay, that's it for the day, and let's meet tomorrow. Thank you so much. Have a great day ahead, guys. Bye bye. Take care.